The stock market is even worse than you think, says this writer on Bloomberg. Run for the hills. The stock market is worse than you think. Welcome to Average Wealth Planning YouTube channel, my friends. Got an article, a quick one that was written a few weeks back that I want to discuss with you about 2 weeks or so. I want to discuss with you here real quick. It's a short one. Boggles the mind. Boggles the mind. This is Bloomberg. Now, anyway, let's dive right into it. Don't forget to subscribe. Of course, thumbs up and comments always help. All right, so here's Stephen Gandel. Never heard of him. There's tons of people out there. I don't follow this regularly anymore. So if I haven't heard of him, doesn't mean he's not legit. Just be advised. So I don't know who Stephen Gandel is, but he is writing for Bloomberg. This is the link I got from thinkadvisor.com. That's a website for financial advisors. It used to be called something else. I forgot what it was. But anyway, thinkadvisor.com. So here's Stephen Gandel's article. The stock market is no longer not just great, it's downright awful. And oh, why am I laughing? All right, so here, watch. PE ratios are expected based on expected earnings for the next 4 quarters. All right, so this is 11/20/2018. And so look, the PE ratios are expected to drop by 18% over the next year. All right, so the stock market is no longer not just great, it's downright awful, says this guy. In fact, after the 550-point plunge in the Dow on Tuesday, 2018's market meltdown, at least in terms of valuations, now ranks among the worst of the past few decades. The PE ratios of the S&P 500 based on the next 12 months of earnings has fallen 17% in 2018. That's the third biggest drop in valuations since 1991, which is as far back as the Bloomberg data goes. All right, so let me just read this to you. The PE rate or multiple, the price to earnings ratio, based on the next 12 months of earnings has fallen 17%. There is the P. This is 2018. The PE ratios based on next year's projected earnings has fallen 17%. Which is the worst and basically the third worst in almost 30 years, roughly. That's bad. All right, so let's keep talking about this. All right, that's only 1 percentage point better than the 18% slide in valuations in 2008 during the financial crisis. The worst valuation drop was in 2002 when corporate profits and the economy, but not just the stock market, were rebounding from the dot-com bust. All right, so here's where it gets interesting. The S&P 500 now trades at 15.4 times what those companies are expected to earn per share during the next 4 quarters. That's down from 18.7 at the start of the year. It's also the lowest point of the Donald Trump presidency, down 8% from Election Day. Stock prices are still up significantly since Trump was elected, as is likely as your 401k. But as I've argued in the past, what investors are willing to pay for corporate earnings, i.e. the stock market's valuation, is a better indicator of their feelings about the direction of the economy and their opinion about the White House policies than where stocks are trading now. Rarely have those feelings soured so quickly, most likely driven by a growing trade war, a not unrelated slowdown in global growth, and rising interest rates, inflation. All right, this is... All right, I'm going to read this sentence to you, and it boggles the mind. The good news is that drops in valuations tend to not last long, especially big ones like this year. In a report last week, some strategists from UBS pointed out that on average, the market has returned 16% in the year after one in which PE ratios have dropped significantly. In fact, going back to World War II, there have been only 2 years in which the market has dropped after more than a 1 percentage point drop in valuations the year before. Parker, the guy from UBS, predicts that the S&P 500 will rise to 3,200 more than 20% by the end of 2019. On top of the valuation, he points to a high consumer savings rate. I don't care what the strategists say. I just don't. But they're also to believe that the traditional rebound won't materialize this time. First of all, while down, the absolute level of stock market valuations is not that low. For instance, the PE ratio dropped to 12.8 in late 2008 before the market rebounded. The PE ended at a lower point than it's now in 6 of 10 years in which there were big valuation drops. All right, the bigger problem is that elements that typically lead to a higher stock market valuations are vanishing. Okay, so what else I care about? This guy is saying the stock market is even worse than you think it is. Why? Because the PE rates have gone down more significantly than any other time other than 2 times in the last 30 years. What? That is good. We want PE ratios to be down. What is wrong with this guy? I sit there and I stutter to think of the absurdity of saying the PE ratios are lower. That's bad. PE ratio lower are good. That means there's more value in the market if you look at the next projected 4 quarters of earnings. This is mind-boggling insane. What we would say is the stock market is even cheaper today than it's been for other than 2 times in the last 30 years. This is crazy. That PE ratios, i.e. valuations, have dropped the most they've done in 30 years other than 2 other times is a wonderful, wonderful point to say, does that mean the stock market is cheaper now than it was a year ago? Yes. Does that mean it could be more expensive now than it was a year ago? Yes. Does that mean if I buy today, I have more of a chance to make money because the market is valued? Yes. Does it mean stocks are on sale? Yes. Why would you look at the negative of this to say the stock market is even worse than you think it is when you're still up, when the market valuations are lower and you still hung in there? Oh my goodness, you're down 10%. Oh no. But the market has a 15 PE relative to next year's projected earnings relative to what it was before at 18. That's a wonderful thing. This is great. This is good news, not bad news. Could it get worse? Sure. We've seen instances where it got worse twice. 2 years. So 2 years, I think he said, since World War II, after a big significant drop off to the following year follow with another drop. Twice since World War II. I'm not saying next year's going to be, I have no clue. You have no clue. This guy has no clue. No one has any clue. But my goodness, you want to buy when things are lower in value. Valuation drives stock prices. The lower the value, the more likely to get positive returns in the future. This is not really debatable. This is, you can't say factual because you don't know what the future holds. But historically, the lower valuations, the higher future returns are, historically. Does that mean it'll happen in the future? I have no, but we don't know. But at the end of the day, it inherently makes sense. If I can buy something for 75 cents on the dollar and I have a feeling that it'll be worth more than $1 in the future, I've inherently made 33% rate of return. But if I can buy that same thing for $1 and I think that it'll be worth 110, I've made, 10% return. Anyway, I just had to point this out. It just frustrates me to no end, just a negative stuff. And the sad part about this, the reason they plug these negative comments and clickbait stuff is because we click on it. Here I am clicking on it. I said, the stock market is even worse than I think it is. Why? So I'm reading this. I said, I better read this. I've had it sitting in my browser tab for a while, as you can tell. I said, I better read this because what am I missing here? And I'm missing nothing. It's the exact opposite of what the article is the exact opposite of what the headline says. Now, this guy who writes the article is still saying, oh, beware, beware. I don't understand it. I just don't. And that's why you got to watch out. The media, when it bleeds, my friends, it leads. Negativity sells. Positivity does not. Especially when it comes to politics, death in the streets, carnage, and stocks. I mean, when it's negative, it's not just this dude's fault. I mean, if we didn't click on negative clickbait stuff, he would not have written it like this. I'm just telling you right now. It's us. It's us. You don't see people protesting. I don't know if you ever watched The Simpsons, but they had an episode where they're all protesting the White House saying things are great, things are good. And no one does that. And no one is going to report on that. When it bleeds, it leads. That's just a fact in journalism. It affects sports journalism. It affects stock market journalism. It affects carnage in the streets, and it affects politics as well. It's sad, but it's our human intuition to say, oh, what's out there? What should I be scared of? Not why I should be happy, but what should I be scared of? And this article right here is not one you should be scared of. This, if anything, this is a positive thing. All right. As always, like what you see, comment, questions, thoughts, thumbs up, and we'll see you next time at the Heritage Wealth Planning YouTube channel. Thanks, guys.